We're a week away, a little over a week from the next Reserve Bank meeting where interest rates are broadly expected to be cut by 0.25%. But here's a few things to unpack before then. Unemployment rate, that's due out on Thursday for one. Our business editor Ross Greenwood joins me now. Ross, will that make much of a difference?
I don't think so,
okay.
No. I think really there's a few other things at play at the moment, but the broad trend is the expectation of 3 or 4 interest rate cuts this year, starting with this month. The Reserve Bank quite clearly cut literally ahead of the election campaign, but then now they get a chance to really start to cut. And that's because inflation has shown clear signs of being in the target band, as we saw when it last came out. So let's just take a look and show this. The unemployment rate, in fact, is going to give even more evidence that they can cut. And that is because economists are suggesting a 4.1% unemployment rate for April, which is dead flat. Right, so from that point of view, nothing is really changing. The employment market remains super duper strong. So here's the odds of a rate cut again. The markets are telling you there's going to be a rate cut. The one thing that has disappeared is suggestions of a 0.5% rate cut. So 98.6% chance of 0.25%. The market's fully pricing that in. But when it goes to a 0.5% cut, they're going, yeah, no, we don't think so anymore. So that's an important one. Here's what interest rate money markets have done this year. So when you're looking at this, have a look at where it started. So at the start of the year, the one-year bond yield, which is the one you look at when you're looking at, say, where rates are going to, was at the start of the year or a year ago, 4.2%. Now you're sitting there looking at it at 3.5%. So already there's only been one rate cut. So the markets, you can see, there are pricing in at least 2 rate cuts. So they're going to get those pretty quickly. So they're the keys for it. So I think this is where you start to see the variety of factors that are really pointing to more rate cuts coming.
So when we talk about 2, NAB said 3 this year, potentially 4. Do you think they come in quick succession, May and June, or...?
No, they get spaced out just a little bit. Probably the last one comes. Normally they like to cut in December. But the other interesting part about this is, so from the government's point of view, coming into office, it's actually a pretty good year to be in office because the economy is going to pick up because of those rate cuts. And so when you're the government, that means if growth picks up, there's going to be potentially more money in the tank. And if employment stays strong, well, that also is going to be pretty good. Then you've got the trade deal between China and the United States. And even though people don't really believe this is actually a proper trade deal, the fact is it's something. And so even the markets are now responding to a bit of that. We'll show you that very shortly.
OK, I want to talk about Woolworths just quickly, because it's saying that it's going to cut prices by an average of 10% to try and win back market share. So where have they lost their share to?
Well, they've lost it to Aldi, they've lost it to Coles.
Okay.
They're just
we do have a bit of competition, Ross.
So we have competition in supermarkets. Who knew about that? And it causes a price response, which we're seeing today. So as a result, what's taken place is that earlier this year, Woolworths basically said it was pouring hundreds of millions of dollars into reducing pricing. But that really was all about trying to get back this market share it's lost. Aldi is the obvious one. You can actually sort of sense that. But the big one is Coles. So Coles has started to pick up and is growing and has been for many, many quarters now, much faster than Woolworths. So Amanda Bardwell, who is the chief executive of Woolworths, came out today and basically said that a whole lot of things you're going to see across the line start to actually be cut in price pretty much from this week. But she also says, hey, this isn't a flash in the pan sale. It's not like this. This is actually a bit more real. So she said today this isn't a short-term promotion. It's about lower shelf prices on the products we know customers regularly shop for. So can I just suggest Greek yogurt and muesli are the ones that I'm backing. So if they put those down in price, I'll suggest that they're real. But the fact is that, but they sense this is real. It's going to cost them a lot of money, but they need to do something to start the growing more quickly, because for quite some time now, they've been growing more slowly than their competitors.
Greek yogurt. So you've got to be careful, Ross, as well. Greek-style yogurt is not Greek yogurt.
No, I know that. It's got to be the potted in the pot,
very good,
brewed in the pot type of one. I have a brand in mind that I really like.
OK,
right?
Well, tell me later.
It's pretty expensive. It's OK.
Added protein, none of those gimmicks.
All
anyway,
those things.
How's the market this morning?
Let's have a look at that, shall we? Because it started out pretty well. And that, as I say, is off the back of that trade deal between China and the United States. And as I say, there is real sort of speculation that this won't last and that the cessation of sort of tariffs between the two is not real necessarily. But the stock market's grabbed onto it. The market's up by nearly 0.5% as we speak. You can see live prices there. It's up by 37 points. And really, if we do see those unemployment numbers and those wage prices this week coming in as expected, then this run is likely to continue.
Okay, nice one, Ross. Good to see you.
There you go.